Hi everyone, good morning. So previously we have discussed about the enterprise value and equity value. Before moving on to valuation and the other types of valuation, I wanted to discuss about other elements which are involved in valuation. So today we are going to start with capital set pricing model, and this is the this is actually in a new topic, and this is actually a building block of evaluation. You actually need to understand these concepts before starting to value any company. So okay, let's get started. Let's start. So capital asset pricing model, capital asset pricing model, and we will be these will be our learning outcomes, and we will be discussing about what is beta and how it measures systematic risk, and we will be discussing about systematic risk, what's systematic and what is not non-systematic. We will be discussing about beta. So beta we will be discussing about systematic risk. We will be discussing about capital asset pricing model. We will be discussing about straight line security market line. We will be discussing about difference between straight security market line and capital market line. We will be discussing about alpha. We will be discussing about Sharpe ratio. We will be discussing about Treynor ratio and how they are used to evaluate performance. And okay, so when we are actually we whensoever we do a DCF, yes, it's easy to do a DCF of a single stock. But when we are doing a relative valuation or we are doing a precedent transaction analysis in case of merger and acquisition, so we will be looking at a portfolio of securities, portfolio of securities or stocks. So that's why to understand these concepts is easy. It's important to understand these concepts so that we could look at a bigger picture. So alpha, Sharpe ratio, Treynor ratio, when we evaluate performance of a portfolio of securities, and how to identify overvalued and undervalued assets using these tools, and how all these concepts connect to modern portfolio theory. So that's what we will be discussing about, and we will be discussing not too deep about the other securities, but today's session is only specifically around capital asset pricing model (CAPM), commonly known as CAPM. So uh, let's get started. So today we are diving into fundamental part of finance, how risk translates into return. So that's what today's topic would be: how risk. So how risk will be translated into return. This is what we are going to discuss, and this is going to be our agenda. So by the end of the topic, I hope you will get a good grasp of what a capital asset pricing model is. And our tools would be beta. We have discussed about it. Beta is going to be our tool. CAPM, CAPM, capital asset pricing model, straight line, security market line, uh, capital market line, Sharpe ratio, Treynor ratio, alpha. These will be our tools. So before we begin with the main topic, let's define every important keyword. So every important keyword, let's define it first. Okay, I just need to remove these uh, things. Okay, so oh, let's discuss about first risk-free rate. So risk-free rate is actually the return on an investment with zero risk. And here the risk is zero. The risk is zero for a risk-free security. And these are securities actually, these are government securities majorly. So short-term government securities are government T-bills, basically. So these are actually risk-free rate. And why government securities are considered to be risk-free rate? When you think about it, just think about it that in a such a way that if governments usually do not default, and even if the government is having a scarcity of money, what they can do is they can always print money, right? So this is why it's government securities are considered to be risk-free rate. So that's the logic behind it. Government can always print money, but government doesn't do this unless until there's a crisis. If you remember during COVID, there was quantitative easing, QE, quantitative easing. Uh, let's okay. So I think this much is enough for today. We will discuss about this thing in detail when we will work on the advanced uh, valuations and all. We will discuss about these things, all the other factors. So, and the second, let's get back to what we were discussing. So the second point here is uh, expected return. Let's understand what is expected return. So expected return is how much an investor anticipate receiving on an asset. So the return investors anticipate. So if I am taking a risk, if I am taking zero risk, so this much is I am getting. If the risk is zero, this much is I am getting. If the risk is zero, so I am getting risk-free rate. Whatever percentage it should be, it's okay. But I am getting risk-free rate. If this risk is zero, if the risk is zero, I'm getting risk-free rate. Let's assume it's 1% or maybe 2%. But what should be my expected return? So I'm getting risk-free rate 1 or 2%, but what should be my return if I am uh, investing in something else? I'm not investing in government securities, but what should be my return if I am investing somewhere else? I am investing. So what should be my expected return? So this is what expected returns mean. And it's denoted by return expected. RE or capital E, small e. Then let's understand what is market risk. So what is market risk? Um, market market return. First, let's understand about market return. So market return is denoted by RM, and market return is the return of the overall market and usually represented by an index like S&P 500, or in India it's Nifty 50 or Sensex. So this is the market return. So if the market is growing by this much percent, how much am I growing? And taking into consideration is the risk-free rate and my expected return. So how much am I growing? So return on the market return. This is denoted by RM. Then let's discuss about market risk premium. So market risk premium. It's important to understand. So market risk premium is the extra return the investor demands for taking market risk rather than investing in a risk-free securities. So, of a risk-free security, so I'm saying that market risk premium. So if I am okay, so if the government the risk-free rate is 2%, let's assume 2%, and I'm letting go. I'm actually investing in the market. So how much above 2% I will be expecting for more risk? I will be expecting more return. So how much should I expect of the how much extra return should I expect if I'm investing in a risk free? And oh, how much extra return should I expect if I'm investing in the market above my risk free rate? So this is actually the market risk premium. I hope this is understood. And let's discuss about the fifth point, which is the total risk versus the systematic risk, and what are the unsystematic risk. Let's understand what is total risk, what is systematic risk, and what is unsystematic risk. Pardon my handwriting. So understand this thing. So risk is actually the overall volatility of an asset. So risk is actually the overall volatility uh, of an asset. And systematic risk is a market-wide risk and it cannot be diversified. This means that uh, you cannot do anything about systematic risk. It depends on the factors like COVID. Let's understand it from a perspective of COVID or recession. These are systematic risk and you cannot do anything about them. So you cannot diversify these away. So just remember this thing, what is systematic risk? Systematic risk cannot be diversified away. But unsystematic risk is something which is company specific and it can be diversified. So systematic and unsystematic, the theory behind this is, in simple terms, systematic is something which you cannot diversify away. So you cannot do anything about it. If it's going to be COVID, it's going to be COVID. If there is going to be a pandemic, it's going to be pandemic. And if the market is hitting the recession, it's going to hit the recession. You cannot do anything about it. You cannot diversify away from this. But the systematic risk, yes, you can do something about it. Okay. So I hope these 5 points are clear to you guys. Let's move to let's understand what actually is beta. So the 6th point here is what actually is beta. And the final point, I hope. So beta is actually it actually beta is the measure of systematic risk. So beta is the risk of systematic risk. And we just discussed that systematic risk cannot be diversified. We cannot diversify the systematic risk. So this means that okay, the basic definition of beta is how sensitive an asset is to the market movements. I'm assuming that if the market is going up, how my stock is going, how my stock is performing. If it's a positive beta stock, the stock will also move upward. But if it's a negative stock, okay, the beta, the relation between the market and the stock, in simple terms. If the market is going up and my stock is also going up, there is going to be a beta positive relation. The beta is positive. And if the is the market is going up and my stock is going down, so this is a negative relation, negative beta, and that's it. So if beta is equal to 1, so this means that the stock and the market are moving in the same direction, but not by how much. So beta is actually a relative measure, but it doesn't gives you exact value in relation to the market. I'm just in simple terms, in relation to the market, how my stock is going to perform. So this means that if beta is greater, so there is high risk. And if beta is lower, then there is low risk. So beta is a measure of systematic risk. It's not very common knowledge. When people ask you what actually beta represent, people or in question in interviews, so the common misconception of the answer is that the beta is a relationship of stock and the market. So no, but yes, it's also true. But the exact value would be, so the exact definition would be that it's a measure of systematic risk, and it actually tells you how an asset is and how sensitive an asset is to the market movements. If beta is equal to 1, so they move same as the market. If beta is greater than 1, so there is more volatility. This means that the risk is high. And if beta is less than 1, so this means that it's less volatile. And if beta is less than 0, this means the relationship is negative and the stock will move opposite to the market. So that's it about beta that you need to understand. Systematic risk, the risk which cannot be diversified. If the beta is 1, so the stock will move in the same direction as the market. If beta is greater than 1, and this means that it's strongly related to the market, the relationship is strong, strong relation. And if beta is less than 1, it means less volatile and means less weak relation. And if beta is less than 0 means that if the beta is negative, so it's opposite to the market. This means that if the market is going up, the stock is going down. I hope this was clear. And this, since we are discussing about it, let's discuss about few or more concepts which would be helpful. When we talk about alpha, what is alpha? So alpha is actually the performance relative to its expectations. So I am saying that we have an actual return of X% and our CAPM expected return was Y%. So alpha, if alpha is greater than 0, so if this value is bigger and the CAPM expected return is lesser, so alpha is going to be bigger. Alpha is greater than 0. So we would say that we have outperformed the market. And if alpha is less than 0, so we would say that we have underperformed. And we are comparing ourselves with the market because beta, if we are using CAPM, so CAPM we are using beta. Beta CAPM cannot be done without beta. And beta is the measure of systematic risk. Systematic risk and systematic risk comes from market only. So which we cannot diversify away. Okay. So we have discussed about alpha also. Few more concepts. Let's discuss about them today, right now only, so that it's better to connect things, connect the dots. So standard deviation, it's denoted by sigma, standard def, standard deviation. So standard deviation is actually a measure of total volatility. If I am saying this is my standard, so my stock, some of, if when I'm working on a portfolio, so some of my stocks will be going up and some of my stocks will be going down. So I do not want all my stocks going up at once. If I'm saying all my stocks are going up at once and all my stocks are going down at once, so this means the deviation from the standard, this is the standard, and my deviation from the standard is high. I do not want this kind of a portfolio. I would want some of my stocks are going up, but some of my stocks are going down. It's okay for me, no problem. But the risk of the portfolio is balanced. So I would want this kind of a portfolios where I'm saying, okay, so if the mean risk is 10%, if the standard is 10%, and I'm saying, okay, at times my overall portfolio, either it's uh, when it's positive, it's 15%. If it's negative, it's let's say 7%. So my return is in between 5 to 15 to 7%. My returns are basically in between 15 to 7%. I hope you are able to understand this thing, what I'm discussing about standard deviation. So standard deviation is how much I am deviating from the standard. So this is 10%. And I'm saying 15%. Okay, if I'm able to generate 15% of return, and I'm able to generate 7% of return, let's little below 10%. But Here the loss is 3% only. Okay, at times we can take loss and it does happens, no problem. But when I'm saying the standard deviation is high, so this means that either my portfolio is generating 20% of return or either my portfolio is generating 2% of return at times given on the market conditions. So this kind of return, this kind of portfolio is very risky and this is not preferred. So understand this thing why if I am generating return, I am generating 20% return, which is above the standard by 10%. So let's assume here also 10%. So standard deviation is this thing. I would want my portfolio to be balanced. Here is the portfolio, here is the portfolio, which is the ideal portfolio. And we will discuss about it in later topics. What does an ideal portfolio looks like? Standard deviation. This is what a standard deviation represents. So when we talk about standard deviation, this is what it represents. Our we want our portfolio to be balanced, and standard deviation is majorly discussed when we're comparing and when we are comparing only when we are doing portfolios. So standard deviation is discussed in portfolios. Okay. I hope this much is clear to you folks. And standard deviation we have discussed. Let's discuss about when we are discussing about it, let's discuss about Sharpe ratio also. So Sharpe ratio is it actually measures return per unit of total risk. And the total risk includes systematic as well as unsystematic. We've just discussed a few minutes back. The systematic risk cannot be diversified. Unsystematic risk can be diversified. This is company specific, and this is actually economic. Economic specific. Think about it from the perspective that uh, uh, Russia, Ukraine, Israel, Gaza. So when two countries are fighting, the systematic risk actually increases, and you cannot do anything about it. The economy is going to get hit. So Sharpe ratio is representing the formula for Sharpe ratio is return on portfolio, then the subtract the risk-free rate divided by total portfolio risk. And the total means total portfolio's deviation. So total portfolio deviation represents the systematic as well as the unsystematic risk. So there are some kind of risk which you can control, and there are those kind of risk which are systematic in nature, and these are out of your hands, and you cannot do anything about it. So total, uh, uh, it actually met the return per unit of total risk. So per unit of total risk, if I'm dividing it by total risk. So per unit of total risk, if it's one, how much risk I'm taking? One, two, three, four, five. If I'm taking 1 unit of total risk, so how much should my return would be? And should be if I'm taking 2 units of total risk, if I'm using 3 units of total risk, if I'm using 4 units of total risk, 5 units of total risk, what should be my return? So we are basically dividing it by the total risk. So that's what the definition is per unit of total risk. When we are dividing it by risk, it's per unit of total risk. I hope you are able to understand. You are able to connect the dots. Okay, so okay, let's move to the next definition, and that's the final one, I think. So Treynor's ratio, and Treynor's ratio measures uh, return per unit of systematic risk. Unlike Sharpe ratio, which measures the return on total risk, Treynor ratio only looks at the systematic risk, systematic risk of the portfolio, and systematic risk is represented by beta portfolio. So similar to Sharpe ratio, it's risk return on the portfolio. We subtract the risk-free rate, and that's the Treynor ratio. So return per unit of systematic risk, return per unit of systematic risk. I hope this is clear. And let's talk about beta one more time. Let's understand that if a stock with beta XYZ stock has a beta of uh, more than one. So this means that the stock might rise by 15% maybe because it's strongly related with the market. It's a strong relation, strong relation with the market. If if the beta of the stock is 0.5, so there is a possibility that it might rise by 5% because it's positive relation. So the stock is going to rise, but here the relationship is weak. And if the beta of a stock is minus 0.5, so this means that there might be a fall of 5% or more than 5%. Here, it's not specific how much it's not calculative. You cannot calculate given on the beta, using the beta, how much the relationship is. So beta is just a relative measure, whether it's strongly related, weakly related, or negatively related. That's it. So there's a possibility, but it could fall more than 5%, or maybe it could it doesn't falls at all. So beta shows how the asset reacts to the market and nothing else. It's just a positive, negative, or a zero relation or a no relation to the market. And you cannot calculate anything else. You just can calculate about the relationship with whether it's strongly related, weakly related, or no relation at all. Okay, so beta is important because investors only get compensated for the risk they cannot eliminate, which is systematic risk. So systematic risk, and I will give you compensation only because that was the risk which you cannot eliminate, right? So that's why systematic risk comes into play. And this is why beta is important because you want to save your return. Okay, so let's discuss, get to CAPM. And now let's decode out the formula. But before that, so what actually is a capital asset pricing model? Um, So the definition here is that it's the relationship between expected return and the risk of an investment. And when you look at this formula, it's the risk-free rate. So the risk-free rate, I'm saying, let's say 2% the government will give me if I put it in the government T-bills. And this one is the market risk premium. If I put my money in the market and the market is moving at a rate of 10%, and so this much return I can get. But since I'm already getting a 2% return here, I'm expecting a 2% return. I'm going to reduce this here. I'm going to subtract it so that it doesn't double count. It doesn't get double counted. So this is 8%. This is a hypothetical question, but this 8% will depend upon my stock, the stock which I am choosing, my stock. Let's just assume that I am saying I am choosing XYZ stock and the market. So this much return, it's going to be dependent on the relationship of my stock with the market. If it's strongly related, if either it's positive, it's negative, or if it's zero. Zero, there is a, I mean, it's going to be no relation at all. So whether it's strongly related, weakly related, or it's if there is a no relation at all. So this is what this will calculate. And if you look at the formula, so expected return is how much I am getting above the market return, above the risk-free rate, given the condition, given the sensitivity of the asset to the market movement. I hope you have understood clearly the formula of capital asset pricing model. Now, and the intuition here is behind the capital asset pricing model is that investors need to compensate for the time value of money factors. Yes, investors do need to get compensate for the time value of money factor RF. Investors also need extra return for taking risk. Yes, this is the extra return. If you're not going with the government T-bills, government securities, then you will be needing more return. And the time value factors, the risk-free rate. And higher beta is this means that it's more volatile than the market. Higher expected return should be there. And if the beta is less than one, it means less volatile and there should be lower expected returns. Okay. So, okay, let's do one example here. So let's assume that the risk-free rate is 3% and the expected market return is 10%. This is expected market return, not market return. And we are talking about expected market return, RM, not about market risk premium. So there is a difference between market return and market risk premium. No, never get confused. Market risk premium is above the market. The premium represents how much we are making above the market. So in the stocks, beta is 1.2. So this means that the stock is positively related, but how strongly we cannot say by 1.2. And when we plug in all these numbers in the equation above, so we will get the risk-free rate is 3%. We will add beta multiplied by 10% and subtract 3%. So this is the market risk premium. The premium 7% we are getting above the market, right? So this 7% premium is that we would expect by not investing in this government security 3%. But this 7% will be influenced by our beta, the relationship between the market and the stock. So this is going to be 3 plus 8.4%. And this is going to be 11.4%. This is our expected return. But whether or not were we able to achieve this return, or have we underperformed or overperformed, this is uh, measured by using alpha. I hope this much was clear. And this is that's why I actually wanted to discuss everything beforehand. And there are one more example where we are comparing two stocks. So if the beta is less than one, so there is going to be lower return because it's less risky. But if the beta is above one, so there is going to be higher return because it's more risky. and assume the same input as before. So if we just change the beta 3%, we change the beta is 0.8 and 10 minus 3. And in second situation, let's assume 3% plus 1.3 into 10 minus 3. So look at the difference here. So here it's going to be 8.6% and here it's going to be 12.1%. And here, because the relationship is weak, so we are expecting lesser return. And here the relationship is strong. That's why we are expecting 12.1 percentage of return. And this is actually because the more strongly it's related, the more risky the stocks get. And interpretation is that the stock B is riskier because of high beta. It requires higher return. And if a stock B actually provides less than 12.1%, investors may avoid using it because it doesn't meet the required return for the risk level. It does not meet the required return for the risk level. If I'm not able to generate 12.1%, 12.1% in a stock where the beta is 1.3, then I would not invest if I'm because it does not require it does not do not meet the required return of the risk level. And is a stock overvalued and undervalued? And we are supposed to know by using let's assume this let's do this example also. Suppose a stock has a CAPM, expected CAPM of 10%, and analyst forecast that it will give us a return of 13%. So analyst forecast is above 13%, the CAPM. So this stock is actually undervalued. This means that there is an opportunity, higher risk, higher return than required. If the forecast was $7, 7%, then the stock would have been overvalued. So analyst is forecasting that it should give 13%, but we are the return is 10%. So the our forecast says that if it's 13%, then it meets our requirement. So it's fairly valued. If it's CAPM, we are expecting 10%, and the stock is able to, analyst is forecasting that it should give 13%. So we will uh, grab this opportunity and generate a 13% return. Our required return was 10%. So CAPM is 10% required return. We require 10% return, but the stock is able to give us 13% return. So it's undervalued. But on the other hand, if the stock is the forecast is 7%, but the stock's CAPM is, because of high risk involvement, it's 10%, then the stock is undervalued. Okay, I hope this much was clear. And we will discuss about the other things in our next session. I hope it has a, I have tried to cover every hidden stock, every hidden spot. So let's move in next session. Thank you for attending the session. My name is Deepak Bisht.